So, hi everyone. Welcome, welcome, welcome to the Nest Egg Builder. We have wonderful Kelly Winget here. Kelly has been in well, she's quite the investor. She runs an investment group. She's the founder of Alternative Wealth Partners, and she is a fifth generation uh, oil and gas family. She does quite a few different things. She's got a great book out called Pitch the Bitch, and I have not read it yet, but I am looking forward to it. She also goes to meetings all over the United States, works with a lot of women's group and other people who want to learn more about alternative investments. So today, Kelly's going to speak to us about the different aspects of investing in oil and gas, because there are so many. When she started talking to me about it, I'm like, well, I didn't know there was a difference between the lease and the minerals and the this and the that. So I asked if she would come in and explain the differences in oil and gas so that anybody who's considering investing would be better educated, so they, when they look at a deck, they can make a better educated decision about whether they wanted to invest in that or not. So how are we, Kelly? Would this be good with you?
Yes, that's great. Obviously my favorite thing to talk about is oil and gas, especially when prices kind of skyrocketed this morning and we're over $92 a barrel.
Yeah, I bet you're very
So
excited about that.
a lot of people aren't, because then it changes at the gas pump, right? But when you're receiving money from oil and gas, you don't feel so bad about spending $100 filling up your car, depending on where you are in the United States. But thank you for having me. I am 5 generations in oil and gas. I have a mix of roughnecks and engineers and investors all in my family, and I get to be an investor. So I'm invested in wells across Louisiana, Oklahoma, Texas, and New Mexico. So a little bit all over the place, well diversified. I do manage, a couple private equity funds. We're invested in all sorts of things. My specialty is alternatives. So I've been exclusively in alternative investments for almost 15 years. I got started in oil and gas, and I still do oil and gas today. And at the end of the year, I get really busy with oil and gas investing because of the tax incentives related to oil and gas. And this is typically what turns new investors onto oil and gas, is either their tax professional or somebody in their financial decision-making team is like, have you ever considered oil and gas investing? Because the tax incentive can really help alleviate a lot of that tax burden, especially if you're a W-2 employee or have a lot of income in the year. Because what oil and gas can do, if you're invested in the riskiest side of oil and gas, which is drilling, like drilling a well, you get this massive tax incentive at 100% write-off of your investment. So this is spread out over a course of 7 years. However, the first year you can deduct up to 100% of your intangible drilling costs. And that expense is made up of everything you're going to put into the ground just to drill the well, whether it works or not. And the government sees that as money you'll never see back, whether or not it works out. So you get to deduct up to 100% of that in your first year, which is typically somewhere between 75 and 85% of the total cost of the well anyways. So if you think about it from an investment perspective, if you make $1 million in a year and you want to not pay 400,000 of that in taxes, you can reduce that by an investment in oil and gas. So let's say you decide you want to put 500 grand into an oil and gas project. You can reduce your taxable income by $500,000, which ultimately saves you between $150,000 and $200,000 in taxes, which is pretty significant. It's a lot better check to write than to Uncle Sam, which you will never see a return on. So this is why I like to invest in oil and gas. It is the riskiest part of investing in oil and gas. It really depends on the operators you're working with. I prefer to work with operators like ExxonMobil and EOG and Devon Energy, which most of those are publicly traded companies. And in the United States, you get to invest in those on the private side as just a normal person, which is really cool. It's kind of the most interesting thing about the oil and gas industry is the ability for a private citizen to still invest in a global commodity at the local level. So it's kind of exciting to be involved right at the wellhead alongside of, a multi-billion-dollar energy company. The least risky part of investing in oil and gas are your mineral rights. And I love mineral rights because they're very similar to real estate. In real estate, you have your surface rights and you have your mineral rights. They're two separate things. Most of the time they're together, but when you're talking about large tranches of land, that is separated. And you could have one family that owns the mineral rights and one family that owns the surface rights. When it comes to oil and gas, owning the mineral rights means that you own all of the oil and gas or precious metals or whatever's in the ground under that right. So any company that comes in and decides they're going to try to pull resources out of the ground, they're required to pay you a royalty. They have to lease that mineral right from you and pay you on all of the discovery that they have, whether it's rare earth metals, oil, or natural gas. When they pull product out of the ground, you're entitled to your pro rata share of that. And typically it's somewhere between 12% and 25% of the gross income from that property. You don't have any exposure to drilling risk other than the fact that if they do a really bad well, you're not going to get paid on the royalty, but it does mean that you get your rights back and you can give it to a different operator and then maybe they'll have success. So you can really invest across the spectrum of how much risk you want to take and how much reward. Obviously, if you're in drilling, you have the highest risk, but also you get all of the net proceeds of the production. And then your lowest risk being mineral rights, which is the real estate. It's very easy to transfer generation to generation because it's just a title difference. You're not paying, some states charge property taxes on mineral rights, but for the most part, you're just receiving a monthly check on the amount of mineral rights that you own, and they're sold in acre parcels. So that's kind of a general overview of oil and gas and the types of way that you can get invested. On the private side, obviously you can buy oil and gas stocks and eventually you'll get paid a dividend, but that dividend is the last drop of money that's coming out of a barrel of oil when you could be at the front of the food chain as far as who's getting checks out of that well, which the top of the food chain is your mineral rights owner because they technically own all the oil and gas in the ground. Then your working interest owners, which are the people that drilled the well. And then eventually after everybody else gets paid, you'll get a dividend on your oil stock.
You did bring up.
So I know it's like a fire hose.
Yeah. So what about, you said something about surface rights. What is that? How is that different?
So it's just real estate. So if you buy farmland and you own the farmland, then you get to determine who gets to be on that farmland. And you can lease the top of the surface rights to an oil and gas company. And they'll pay you a lease fee. So they'll say, we want to go find out if we can find oil on your property. And so they'll pay you a lease bonus. That lease bonus will pay you for their discovery. So they go and figure out if they're actually going to drill a well. So they might pay you $10,000 for the like the 5 acres on your property that they're going to use to drill a well. Then they decide, okay, we're going to drill a well, so we're going to need access to this part of your property for the entirety of this well's life, which could be an immediate failure, right? If the well doesn't work out, then they don't need to be on your property anymore. Then they have to put the property back together. Or if they have a successful well, that well could be there for 100 years. So because they need access to that piece of your property, the surface rights, they'll pay you a lease because they have to come on and off your property to deal with their well. So it's like having a renter on your property. And it's really good for farmers who have, tens of thousands of acres, and this oil company wants to use this, back corner of their property they're never on, and maybe the cows come by, but they'll get to earn income off of that piece of parcel while not disturbing the rest of their land. Typically it's out in the middle of nowhere, but it can be closer to civilization in certain parts of the country.
Okay. And the people that own the mineral rights, aren't they usually the drillers? People that drill and put in
No.
the
Mm-mm. So anybody can actually go buy mineral rights. If you have a really good realtor, they'll understand how it works. But there are marketplaces that people are selling their mineral rights to. There are companies that specialize in management of mineral rights. They aggregate capital. They buy portfolios of mineral rights in certain areas under certain operators. If you don't know what you're doing, it's better to work with an asset manager that does, because it does require a lot of like boots on the ground, paperwork wise for mineral rights, because these are really, really old assets. So my family's mineral rights that are out in Louisiana are almost 100 years old. So the original documentation from our deeded mineral right, and we own the surface too, but our deed is recorded by hand on paper in a courthouse in a very, very small town in Louisiana. This is all over the country, and whether or not they're up to date, if they've digitized their courthouses or whatever, you have to find who owns that mineral. And it's been traded a lot. Like for farmers who own large pieces of land, it's easy for them to not give up their actual property, but to sell their mineral rights in pieces to like pay for a new tractor or send a kid to college. They can just say, okay, I'm going to sell 100 acres of my mineral rights to this oil company for $100,000. And then the farmer gets $100,000, they send a kid to college, but they still have all of their tens of thousands of acres. And this oil company has 100 of their mineral rights. As an individual, you can go find mineral rights that are for sale. And what you want to look for if you're looking at mineral rights is, are the mineral rights in an area that is actually being developed by oil and gas companies? So you don't want to overpay for mineral rights if they're never going to be developed. Mineral rights have no value if there's never going to be oil and gas produced from that property. So you want to look for property that's around oil and gas development. It's also really good to look at things that maybe aren't completely developed. Like going in the middle of the Permian Basin in Texas is not a good place to go find a good deal on a mineral right, right? We know there's oil there. All of the majors are producing there. So you're going to pay a premium on a mineral right there because you know that it's going to return something because there is oil and gas production. You want to be a little bit outside of that so that you can get a good deal on a mineral right where there could be production, so that eventually when an oil and gas company comes in, they pay you for your lease of your mineral rights, and then you get a piece of all of the production they're going to do. So that's why you should work with an asset manager, because it takes a lot of work to figure out where those places are, what makes a mineral valuable. I mean, you could take the time and the effort to like learn the space and then go out and buy the mineral rights on your own. But there are lots of companies that do this really well.
Mm-hmm. Yeah, well, and your company's one of them, is my understanding.
We like to drill. I do know really great companies that do mineral rights, and we do partner with them if we want to go that route. But right now we're focused on drilling just because the tax incentive is there, and oil and gas prices are really high. So the return potential through the drilling with the tax incentive is way more appealing to us, as we're targeting, double-digit returns.
So if you're doing the drill, do you own the mineral rights to do the drill? How does that work exactly?
Yeah, not necessarily. Sometimes if you have it'd be a really good deal if you owned both the mineral rights and the lease to drill the well, because then you're getting the whole spectrum of the return, right? You're not paying a mineral owner when you produce oil. You're paying yourself, right? You get to keep that royalty in addition to the working interest that you have in the well. So what we do is we invest in the operator, and so we're invested in the working interest. The operator, the sponsor that we're working with, is the one who's leasing the property and the minerals from the royalty owners. We drill the well, and then we get all of the net profit from that production. And so we're coming in from that angle, and that's because that's where the tax incentive is. If you're able to basically deduct your entire investment into a successful oil and gas investment, you have a built-in about 40% return just off the bat, just because you're not writing a check to Uncle Sam. Mm-hmm. So then all of their future return from that is now free cash flow for the life of the well. And you have the choice of when and how you sell that interest. So you can hold it for generations, right? My family never sold its mineral rights, so I'm the recipient of 5 generations of oil and gas income from the same wells. So there is potential for wells to produce for really, really long periods of time as technology changes. So today, you see a majority of your production in the first 3 years. Us as a firm, we look at operators that can produce a return of at least our capital in under 3 years. And that's at $65 oil. Oil's at $92 today. I think it went down to 91 something, but it got up to about almost $93 today. What we look for is that a company can go in, drill a well in an area, and return our capital within 36 months at $65 oil. If the project cannot do that, then we don't invest. So when you're getting pitched different types of oil and gas opportunities, because you probably will, because oil and gas is high now and oil and gas companies come out of the woodworks now, is that you really want to see what the economic picture is. Can they produce a return in under 36 months at $65 oil? So can the production at $65 oil return your capital in under 3 years?
That's good. We'll put that on our checklist. So thank you.
There's a lot of risk, and it's kind of a scary place to be invested. But if you're working with the right people who can walk you through how this all works, there is a lot of opportunity here, because you have Wall Street that's completely exited the oil and gas industry. And that's just through ESG mandates or whatever else is going on. Banks won't lend to oil and gas companies anymore for the same reason. So you have this huge gap of funding for a global commodity that has to be produced. So unless people start investing in the space, oil and gas is just going to get more and more expensive. So you can be part of like the solution and make money, right? We want to reduce the expense of oil and gas. Everyone makes money and consumers feel good when oil is at $65, but that can't happen unless people invest. So we get to enjoy the upside right now at $90 oil, and eventually more money will flow back into the space, and it will come back down to reality and be $65 a barrel again.
Oh, yeah, it does fluctuate, doesn't it? So something that we consider, our group considers really important, investing with the right company. So how do you know what the right company is? Because there's, since the 80s hurt really bad, particularly in Texas, really badly. And of course, everybody wanted you to invest at that time, which of course would have been the right time to invest, because you would have gotten in for really inexpensive. But now you're right. There's a lot of companies out there. We get hit all the time with, well, we're going to do 2 drills. Like they've got the mineral rights and the land lease on 2, where they can put 2 wells. But that's not very big. Is that a good kind of company to work with when they're only doing a couple? Or, can you explain what the right company is?
Sure. It depends on how big the project is, right? If you're working with an operator that's drilling a well or 2, Depending on the size of the company, that could be $1 million total project. Or, if you're talking about a major driller, then those projects can be $10 to $15 million.
Mm-hmm.
The size of the well can really change depending on the strategy. So, like ExxonMobil will drill a 2 mile down, 2 mile over lateral well, and that'll cost $14 million. But that well could also kick out $14 to $15 million a year, easy. Or you can go with a smaller operator where you have $1 million project. The well might do 10 to 50 barrels of oil a day, and that project will still return capital in under 2 years. It's just depending on the size of investment you want to make. On a smaller well, your unit size might be $60,000. On a project with ExxonMobil, we're investing $2 million at a time. So it's really about what your threshold is. Smaller owner operators aren't bad people to invest with, but you should look at their track record and where they're drilling. Are they drilling somewhere brand new to them, or are they drilling somewhere that's familiar? There's not like brand new oil and gas companies. There's brand new oil and gas sponsors who are buying prospects from experienced operators. You don't necessarily have to go through some of those to get to those projects. And, for your audience, I'm happy to walk through how to source those deals if they want to go directly to the operator. Or if they want to go through a fund, obviously we can help with that too.
Thank you for that. Any questions from anyone? I know you're all really experienced in gas and oil. That's why you're here. So
I love to do it. I typically do between 10 and $15 million in drilling in the month of December alone.
What is it because of the tax write-offs?
Yes, it's because of the tax write-offs. You can, in fact, invest in oil all year round to get the same tax benefit, but for whatever reason, everyone likes to come and talk to me in December.
That's hardly enough time, but that doesn't matter, I guess.
It's very hard to find good projects in December because everybody's looking for them. And there's only so much. Like, you can't oversubscribe to oil and gas because the cost of the well is the cost of the well, and that's what you're paying for. Mm-hmm. If you're overpaying for the cost of the well, there's a bunch of markups in there, and you're really just paying inflated salaries to people that aren't actually drilling a well.
Thank you. Jana.
Kelly, thanks for giving us an intro to oil and gas. I have lots of questions. Can you walk, let's see, we'll have to pick one, right? Walk us through an investment in drilling, since that's what you do a lot of. So what does it look like for an investor? Do they got to be accredited? Are there minimums? What are the hold periods, the cash flows, the average returns?
Yeah. So for things that I do, you do have to be accredited. So you have to have that $1 million net worth or a $200,000 income. With mineral rights, you don't necessarily have to be accredited because it is just real estate. You can buy whatever you want, and there's not really a barrier of entry. But in the drilling side, because there's significant risk, like, you need to be a sophisticated investor in order to take that risk. You get an incentive for that, which is the tax benefit. But most of the time when you're invested in drilling, depending on where you come in on the project, typically you make your investment. In about 6 months, that well will be permitted, drilled, and producing if it's successful, right? They'll test the well. If the well tests correctly, they'll complete it. That completion will then turn the well online and send it to sales. So from the time that you make the investment before you start to receive return is somewhere between 6 and 8 months. If you're directly invested in an oil and gas well, then once revenue starts on the well, you'll receive your pro rata share of the revenue every month following that first check. And that's because they sell product once a month. They'll come pick up the oil, and they'll sell it, and then you'll get your check. That check that you receive is from the previous month. So it's about a 30-day lag. That's why you see a 30-day lag from the price at the gas pump too, because they're buying contracts a month before it gets turned into anything. If you're going through a fund, it really depends on what their structure of the fund is. The way that I manage my energy fund is we invest in oil and gas across projects that are already done, projects that are getting ready to drill. So it's kind of a blended rate of return. But once we start revenue on those wells, we send out quarterly dividends of whatever production we have from any of the wells that we've turned on.
Like, because you're invested
you
in the
receive
whole,
your tax.
that's like you're invested in the whole project, right?
Right. So mine is a diversified fund. So you're invested in like several different owners and operators, whether that's a EOG, ExxonMobil, or like a family-owned operator. We have diversification over where we drill and who we drill with, and that just helps us mitigate a lot of risk as far as our return goes. Because if I'm only drilling with small operators, then I'm dealing with a lot of risk there of like how they're funded or their operational risks. Obviously, ExxonMobil is going to be able to get rigs on site a lot faster than somebody who's really, really small, because the operators that are working under ExxonMobil have massive contracts. So they're going to show up to that job way before they're going to show up to $1 million job. So we just create a blend, and those returns are sent out on a quarterly basis. The tax returns are sent to investors as K1s. They just put the K1 into their tax return. We work with CPAs to figure out how that works into people's individual tax situations. But our tax return, our K1 document, separates out the intangible drilling costs from the tangible drilling costs. The intangible drilling cost is 100% deductible in the first year of your investment. And then the tangible drilling costs are deducted over 7 years, with the majority of that in the first year. And so we work with people's tax people to figure out how that works for your specific tax situation.
That sounds great.
And these are considered active losses, and that's why it can offset W-2 income?
Correct. And if you're directly invested in an oil and gas well, like without a fund manager or a sponsor or anything, then you are liable for any type of extra expense. So like, let's say you make your investment, they drill the well, then there's something that happens, and they have to like bring a rig back on site. Then you're responsible for your pro rata share of that capital call. You have to continue to pay for the drilling expenses. The way that I have our fund structured is that I actually keep a reserve so that I don't have to go back to investors and ask for capital calls unless it goes past that. But typically, if it looks like it's going past that, then we don't continue with the project, because then it becomes a money pit. But if we've completed the well, it gets turned online, and we have reserves left over, then those reserves are then return of capital to investors, because we don't need that capital anymore.
But you said that they could be drilling for 100 years, not drilling, pumping for 100 years. So
right.
But this has to do with the well itself, the drill itself, right? The reserves are for the equipment for the. So don't you always have
for
to
the
hold
actual
the reserve?
No, because once a well is online and producing, the expenses are taken out of that revenue.
Okay.
Unless the only time you get a capital call after revenue is being produced from the well is if there's something significant that happens that the production doesn't cover the cost.
I see. So they actually do keep reserves, but they keep it out of the cash flow, so to speak.
Right. It's
right. So
it's a pretty it's a regulated industry. So that production is reported, at least here in Texas, to the Texas Railroad Commission, and you're entitled to that income from the well. Now, where it gets with certain companies mucky is when the expenses for the well remain really high even during production, because you do have, like, as a working interest owner who's invested from the drilling perspective, you get the net profit of the well. So your expenses are covered out of the revenue of the well, and then you get whatever's left over. So you want to work with someone who's really efficient, because you want a majority of that going in your pocket, right? You don't want it going to the operator. Once the operators drill the well, it should be a really low cost, low maintenance thing.
Mm-hmm. Because there's still maintenance. So it's just like a multifamily, right? You only get from the net.
Right.
Right. I'm sorry. Go ahead, Jonna.
It's okay. So when the well starts producing, and then you're getting cash flows from that, does that just continue until it end? Can you sell it, or is there a natural end?
So there's a couple different options. One, you can, if you're directly invested in a well, you can hold it for as long as you want, until the well dies. When the well dies, like, that's kind of the end, and the lease expires, and that's all she wrote. You're responsible for plugging that well, but typically most oil and gas companies have that money set aside for the plugging liability, so that they're not having to go out to investors, 20 years down the road and ask for more money to pour cement down a drain. The other option is, if you're going through something like a managed fund, like what we do, our exit strategy is to eventually sell it. We'll either sell some of our interest at auction, and there's just a bunch of buyers that always want to buy production, or we'll sell the entire portfolio to a larger private equity company, or myself will just buy people's interest out, because I want to hold these assets long term. But these can produce for a significant amount of time. If we're invested through another group, for example, we're partnered with a large family office. They wrote a $100 million check, and we wrote a $2 million check. When that $100 million family office wants to sell their interest, we are going to be selling our interest with them. But there is a secondary market for these investments.
I bet there is, once it starts flowing, because the whole risk is before it flows. Right? Oh, well, now we get a proven product.
Yes, family office really likes to buy oil and gas right now. It's very competitive in the secondary market at the moment for production.
Okay. Jonna, any more questions? Because we are right close to the top of the hour.
I don't think so. I think that was most of the ones I had written down.
Anybody else? Tina, Ted, any questions? Giselle? Maria, how about you? No questions? Okay. Well, my, you were able to answer everybody's questions. That's really great, Kelly. Thank you very much. And in a short period of time.
I know I kind of like information overload, and I'm sure people will go forth and start doing a bunch of reading and research, and I'll always make myself available if people want to talk through something.
Okay, great. Yeah, so if anybody wants to be in touch with you, we're happy to send them over to you, particularly around the oil and gas, because we are being approached by, so I think we've had 4 different oil and gas approaches in the last 5 or 6 months. And because I don't know enough about it, it's not our forte. We're basic commercial real estate capital raisers. I'm very leery to suggest to anyone this is good. But now that we've met you, you could hold our hand, or we would like to learn about what you actually have and look at your deck and your fund and learn more, if that's okay with you.
Yeah, I'm totally okay with that, and it doesn't always make sense for everyone's portfolio, but I mean, I love oil and gas. I'll always be invested in oil and gas, and the more people that can get involved on the private side, the more people who can benefit.
Yes, agreed. Well, that's all what we're about. We want people to have their benefits and their legacy, so it's really important.
Yes.
And you have a lot other background, and we wondered if you would come on and speak again on one of your other subjects, of which you are the great expert. Would you be willing to do that?
Yeah, I'll come and talk about alternatives, and I'll be on camera when
Need to do that. That would be really great. So I want to thank you very much for being here today, and
thank you.
please come again.
All right. Thanks, Peggy. Bye, everybody.
You don't have to leave yet if you don't want.
Oh.